Hi there, my name is Jason Ayers, CEO of the Croft Financial Group and a member of the Investment Review Committee. On behalf of the committee, thank you for taking the time to watch our Portfolio Manager's Brief for January 2021. Now, 2020 certainly wrapped up a lot better than expected for North American equity markets, despite the underlying and continued concerns over the ongoing pandemic, as well as the social and political unrest. The S&P 500 closed the year positive 16%, while the tech-heavy Nasdaq added an impressive 43%. Canada's S&P TSX Composite managed a 5.5% gain, driven mostly by its tech constituents. Now, since our December brief, we've witnessed the storming of Capitol Hill on the heels of a now confirmed Democratic sweep in the United States, alongside of continued concerns as to what impact the new COVID-19 variants and their apparent increased transmissibility might have on the reopening timeline, as well as how quickly the vaccines can be administered and their relative effectiveness. So far, 2021 has not been the fresh start everyone was hoping for as we progress through yet another lockdown as a result from the concerns mentioned. However, despite the obvious challenges and continued stress on the economy, we remain bullish on the outlook for the year. Yes, there will be challenges along the way. However, we're moving closer to that much sought after return to normalcy, which should bode well for the financial markets. In looking back to our December brief, we'd suggested that a Democratic sweep might make it difficult to pass progressive legislation in support of greater economic stimulus. The consideration was that it would be the Republican Senate seats that would push for maintaining the status quo as far as economic relief is concerned. However, the Biden administration is currently pushing a $1.9 trillion COVID economic relief plan that is being labeled too expensive by both Republican and Democratic lawmakers. And while this latest holdup has likely been the cause for some stock market volatility, the trend remains decisively to the upside based on the expectation that the plan or something similar will pass. This strategy of spending our way out of the pandemic does come with some legitimate concerns for Canadian and U.S. investors as central banks continue their massive monetary and fiscal stimulus. The first is that expectations have been set for relief benefits, grants, and forgivable loans, along with low interest rates to keep people spending. Any deviation from this will surely be met with both economic and political unrest. As such, the taps must remain open, so to speak, to improve or at least maintain the status quo. And it will become increasingly more difficult to wean the economy off of this cheap and easy money environment. A problem for another day, perhaps. Now, the second is the risk for an unexpected inflationary spike in the second half of the year as pandemic stresses lift and pent-up demand along with a healthier household balance sheet results in a spending surge. The question as posed in our December research report entitled Inflation Risk on the Margin is whether this spike in consumer demand will lead to an inflation scenario like the 1970s, during which the markets experienced a 50% sell-off. Now, when Fed Chairman Jerome Powell was asked this question during his press conference following the FOMC meeting in December, he confirmed that in their view, inflation will remain manageable, with their projected increase not nearly enough to change their current strategy. That said, a more serious spike would have an impact on the relative valuations across asset classes and is worthy of us paying attention to. Our consensus view is that we are not likely to see an unmanageable spike in inflation, nor a 70s styles correction in the market as a result. While we may see a surge in prices where the pent-up demand exceeds supply in certain sectors, this is likely to be kept somewhat in check as businesses compete for consumer dollars by keeping their pricing competitive and production ramps up to meet demand. Furthermore, any immediate jump in prices in the sectors that have suffered the most, such as travel and leisure, restaurants, and bricks and mortar shops, is likely to be short-lived as supply catches up with demand. As such, inflation pressures should ease, allowing central banks to maintain their strategy, with rates normalizing sometime in 2023. Regarding current market valuations, the question remains: does this rally reflect an economic rebound, or are we witnessing a bubble within a global pandemic? While one could certainly make a case that some sectors and individual companies seem to be exhibiting bubble-like characteristics, we believe current estimates are justified for the most part. To sum up our current outlook, first, central banks have been trying to boost prices for the past 10 years with little success, which reduces the probability of an indigestible spike in inflation under current circumstances, and, as such, the risk of a significant market correction. And second, we do not believe that financial markets are significantly overvalued. Our expectation is that the 10-year yield will remain around 1%, which means that fixed income assets will continue to take a backseat to equities as investors seek a real return. And given reassurances from the central banks that they will continue to support the economy by maintaining ultra-low interest rates until it's fully recovered, this is likely to be the case for the next couple of years. For more insight into our expectations for 2021, please check out our research reports posted at www.croftgroup.com. Remember to be good to one another, stay safe and healthy, and on behalf of the Croft Financial Group, thanks for watching.